Hello, everyone. Welcome once again to Under the Macroscope, Skybound Capital's weekly podcast. Good news, the brothers are back. They joined us recently for some commentary on the 60-40 portfolio split. And as part of that conversation, towards the back end of that podcast conversation, the very real impact of inflation was raised as being a factor influencing portfolio allocation. So we thought what we do this time round is to explore inflation and current inflationary environments in a little more detail. So Carl and Xander Engelhard, welcome back, analysts here at Skybound Capital. First of all, why is inflation making so many news headlines of late?
Well, excellent question, Matt. Good to be back. I guess the first podcast was so nice, we had to do it twice. So before we answer that question directly, we need to take a step back as to what central banks did in response to the pandemic. So the pandemic initially caused a global income shock, which collapsed spending and ultimately halted economic activity. Now, what's important for our listeners to bear in mind is that one person's spending is simply another person's income. So the downturn caused by the pandemic was quite unique compared to a normal downturn because the collapse in income wasn't necessarily caused by tightening of monetary policy. It was actually caused by people who had to simply stop working as a result of the lockdown restrictions which were imposed on us. So in this kind of environment, normally central banks would lower interest rates in order to stimulate the economy. However, interest rates were already around 0% when the pandemic hit, so this simply just wasn't an option. So in order for central banks across the globe to really stimulate the economy, they printed unprecedented amounts of money in order to purchase government bonds. And this enabled governments to run various COVID support programs, which we saw across the globe, such as in the US, where stimulus checks were posted by mail. UK, they had the furlough scheme, and Australia had the JobKeeper support program. And the primary objective of all of this was just to simply keep the economy going. So one of the main concerns among investors regarding the unprecedented stimulus measures conducted by central banks was basically the increased liquidity that was provided to markets in order to augment the loss in income amid businesses completely shutting down. Was what will happen with regards to demand and supply, and will there be a mismatch? And this could potentially lead into higher inflation. And it's also important to note that higher inflation does erode the purchasing power of our money as well as investors' capital. So these price pressures have started to occur and also have essentially basically resulted in the Fed to change their dovish 2020 monetary policy stance, where the majority of members didn't anticipate interest rates to hike until, let's say, late 2023, early 2024, to a progressively more hawkish stance, okay? And where the Fed wants to start tapering back their bond repurchase programs this year and have that pretty much concluded by middle of next year. So in short, what has been driving Fed's monetary policy stance, or the change in that, is simply inflation. And this is amid data suggesting that there's still plenty of slack in the US labor market. And we know that the Fed had two main objectives in navigating the US economy out of this pandemic environment, and that was to achieve maximum employment as well as allow inflation to rise just a bit above that 2% mark for them to achieve their long-term inflation target of 2%. So the one objective is definitely being met, which is high levels of inflation. And the second objective, which is labor market recovery, simply just isn't met yet. And this kind of puts the Fed in a bit of a precarious situation where they have to make a trade-off between price stability as well as labor market recovery. And the choices that the Fed makes, it impacts various asset classes. And this is why inflation has just been such an important topic of late.
So COVID, the pandemic, has presented us at a macro level with a unique, extraordinary, unprecedented set of circumstances. But what have been the key drivers of inflation in the past?
I mean, when analyzing economic data, what we have seen is that there's a significant relationship between the cost of labor and inflation. And what I mean by that is essentially when we see prolonged increases in labor costs, that generally results in elevated levels of inflation. And when you think about it, it actually makes complete sense. I mean, when you look at a company's financials, the largest constituent generally of operating costs is salaries and wages. Now, the question is now then what drives the cost of labor? And that's mostly tight labor markets. What's quite interesting, though, is that there have been periods of time where the US economy has experienced a tight labor market, which has led to rising labor costs. However, inflation hasn't necessarily materialized. And the most recent example of that is the period of 2016 to 2019, where you had the tight labor market, you had a significant rise in labor costs. However, inflation remained around that 2% level.
So why has inflation remained around that 2% mark for almost the past 2 decades?
Yeah, it's still under debate. I mean, there's 3 primary reasons which have essentially been cited by economists. The first one is inflation expectations. I mean, inflation expectations have been anchored around that 2% level for so long. And this essentially means that companies and workers have not necessarily built in higher inflation expectations into their behavior when it comes to negotiating for wages and prices, for instance. The other one is the long-term secular effects of globalization and automation. I mean, this has also weakened workers and companies' abilities to raise wages and prices. And the last one, potentially, there may have been an underestimation by US officials as to what the US economy's potential is in terms of production capacity. So, I mean, the idea here is that when the economy gets hot, it pulls in marginalized workers. This would be workers that are currently outside the labor force. In the hot economy, they then enter the labor force and create additional capacity as well. So there are many reasons why this could have been the case, but I mean, those are the primary ones.
So I don't know which one of you wants to take on this question, but what are your thoughts on Powell's transitory argument?
Excellent question, Matt. I probably would have asked that myself, but the recent rise of US inflation has basically been attributable to a modest rise in services and a sudden rise in durable goods. Now, durable goods are goods which typically last for three or more years and are things like such as furniture, appliances, cars, those kind of products. So if we look back over the last 25 years prior to the pandemic, we can all agree that inflation has been around that 2% mark. And the primary drivers of US inflation over that 25-year period, so dating back to about 1995, is services costs, which have been rising about 2.6% per annum, and durable goods, which actually have been declining by about just under 2% per annum over the last 25 years. Now, what the pandemic has done is actually change this entire dynamic where durable goods has become a large driver of the recent rise in inflation. So if we, like, for example, look back at the July inflation number in the US, that's when inflation really started kicking into gear. The headline or core inflation was 4.2%. Now, services during that month rose about 3.5%, whereas durable goods actually rose 7%. So that was twice as fast as services, where historically it has actually been a detractor of inflation. So kind of what could have caused this sudden rise in durable goods or demand of it? Well, there's 3 primary reasons. So it's the stimulus checks, which I mentioned earlier, and that was to augment the loss in income, but businesses were actually shut down during this time. So that was the demand-supply mismatch. And then households were basically shifting their spending habits, and this is due to the lockdown restrictions. People didn't have as many opportunities to travel, dine out, etc. And this all was exacerbated by simply supply chain bottlenecks, which we're still facing today.
So key question incoming. In your opinion, is inflation here to stay with us? And if so, for how long? Are we talking short, medium, long term?
I'll take this on, Carl, if you don't mind. I mean, once the pandemic-induced bottlenecks ease, inflation should taper off. The secular forces of globalization and automation are not necessarily expected to go away. And taking that into consideration, the recent rise in durable goods would likely revert back to its long-term trend. So Powell does make a valid argument in terms of transitory inflation. One of the main things is what I think it's important for our listeners to bear in mind is that transitory inflation doesn't necessarily mean short-lived inflation. And the main question is how long this transitory period will last and what its impact on inflation expectations will be going forward. So in addition, another thing is that, for instance, the pandemic has also exposed key risks to the global supply chains. Both companies and countries now have to rethink how they can mitigate these risks. And whether this means more products are going to be produced domestically, so in other words, deglobalization or not, the process of making these supply chains more robust is going to come at a higher cost, and therefore will likely result in higher prices. But taking all of that into consideration, what I would like to note is that we typically refrain from trying to predict what markets are actually going to be doing next, and we rather focus on building robust portfolios that can navigate multiple market environments. So for instance, there's the old Assistant Secretary of the US Treasury during the Nixon administration, Edgar Fiedler, famously once said, "He who lives by the crystal ball soon learns to eat ground glass." And what we essentially take from that is we don't try and take bets on any single outcome. We rather want to position client portfolios to have the ability to navigate multiple outcomes. I think, that's our thoughts on that.
So as an investor, what tools are at your disposal in terms of hedging against inflation?
That's also a very good question. So there are basically a variety of assets one can invest in as an inflation hedge. The basic principle is to invest in assets which have the ability to produce real returns. So in other words, that's basically invest in assets which can produce returns in excess of inflation. So if we focus on listed equities, for example, companies which investors should consider are, as we mentioned in our last podcast, quality companies, as these companies tend to have pricing power and are able to pass on these rising input costs, which are induced by inflation, to the end consumer. And this protects margins, real revenues, and those kind of things.
Well, fascinating as it was last time, and you're really growing into this podcast role. So we look forward to the next appearance of the Engelhardt brothers. Thanks again for your insights. Fascinating to get them. Don't forget that the Under the Macroscope podcast is available on Apple, Spotify, and the Google podcast platform for Android, and all past editions of Under the Macroscope available at www.skyboundcapital.com. Until next time on Under the Macroscope, have a great week.